Something I have said to clients for years tends to stop people mid-sentence. Some retirees watch their net worth go up after they stop working. Not because they got lucky, not because they had more saved than everyone else, because retirement, if it is structured well, removes some of the largest financial drains of your working life all at once and replaces them with income that compounds in ways a salary never could. When I looked back across 25 years of client files, the retirees who worried me most going in were not always the ones who struggled. Sometimes they were the ones who called me 3 years after retiring to say their net worth was higher than the day they stopped working. Not by a little, meaningfully higher. There is a real structure behind that outcome, and there is one piece of it, I want to get to it before we finish today, that most people have never calculated. Once you see it, the whole picture of retirement changes. Reason 1. The tax situation completely changes. Here is something most working Americans never fully reckon with. When you are earning a salary, your tax burden is essentially fixed. Federal income tax, state income tax, FICA, it comes out before you ever see it. For a household earning $100,000, the effective federal rate alone is typically somewhere between 13 and 17%. Add state taxes and payroll taxes, and you are often losing 30 cents or more on every dollar before you make a single spending decision. Retirement restructures that picture in ways that are genuinely surprising until you work through the numbers. Say you're drawing $60,000 a year in retirement. $30,000 from Social Security, and $30,000 from a traditional IRA. The IRS does not tax all of Social Security. For most middle-income retirees, roughly 85% of the benefit is taxable. But that still means $4,500 of your Social Security check is not counted as income at all. Now add the standard deduction, which in 2024 is $14,600 for a single filer and rises to $15,700 if you are 65 or older. A married couple over 65 gets $30,750. The taxable income left after those deductions often falls into the 12% bracket or lower, a rate many of these same people never saw during their working years. If any portion of that money is coming from a Roth account, it does not count as income at all. It's simply not there as far as the IRS is concerned. Think about your current paycheck for a moment. Not your gross salary, what actually lands in your account each month. Now think about what 12% federal tax on a much smaller income base would feel like compared to that. That gap, that's real money that stays with you in retirement. For a lot of people, it's thousands of dollars a year they were not expecting to keep. And the tax shift is only the first piece of this. What comes next, the expense side, is where I watched people's retirement confidence change most dramatically when they finally saw the real numbers. Reason 2, your expenses just absolutely crater. Most people approaching retirement do their budget planning using their current spending as the baseline. That feels logical. It's also, in most cases, significantly wrong in the direction that actually helps them. I worked with a man named Richard. He was 63, had spent 31 years as a civil engineer outside of Columbus, Ohio. He had $490,000 saved, a paid-off house, and a quiet dread about whether it was enough. When we built out his retirement budget together, he kept using his current spending as the baseline. That seemed logical to him. What we found when we went through his actual bank statements, not what he thought he spent, but what he spent, was that a substantial piece of his monthly outflow was work. Commuting costs, the work wardrobe he refreshed every couple of years, lunches, the dry cleaning, the convenience spending that comes from being exhausted and time poor, takeout because there was no energy to cook, a lawn service because there was no time to mow, a cleaning service because weekends were already gone. Richard was spending somewhere between $800 and $1,100 a month on what I came to call the cost of employment. It wasn't extravagant, it was just what working full-time required. That category disappears in retirement. And on top of that, Two of the largest line items in most American budgets tend to resolve around this same life stage. The mortgage, if planned well, is paid off, and the children, genuinely one of the most significant financial loads a household can carry, are grown and self-supporting. The Bureau of Labor Statistics consistently shows that households aged 55 to 64 spend significantly more per year than households aged 65 to 74. The drop is not imaginary, it's structural. Reason 3. Compound interest becomes your best friend. Most people understand compound interest in theory. What they underestimate is its shape and what that shape means for someone who's 5 or 10 years from retirement right now. The growth is exponential, not linear. The first 2 decades of saving, you're doing most of the work, contributing from your paycheck, building the base. But the last decade before retirement and the early years of retirement itself, that's when the portfolio starts carrying its own weight. The dollars you saved in your 30s have time to multiply. A contribution made at 35 isn't worth what you put in at 65. It's worth 3, 4, 5 times that, depending on the return and the timeline. Here's what that means practically. Say you have $600,000 invested at retirement and you need to withdraw $40,000 a year to supplement Social Security. If your portfolio is earning an average of 6% annually, roughly in line with what balanced portfolios have historically returned over long periods, according to Vanguard's long-term return data, you're earning $36,000 in growth on that balance in the first year alone. You withdrew $40,000, but the portfolio only declined by $4,000. And next year, a slightly smaller base still earns substantial growth. Many people picture retirement as a withdrawal problem, a jar you're emptying. The math often makes it something closer to a river. You're drawing from it, but it keeps flowing. Reason 4. Social Security is more valuable than people think. Most people I worked with underestimated Social Security in one very specific way. They focused on the monthly number, whether it seemed like enough, without ever thinking about what that guaranteed income does to the rest of their financial picture. And that's where the real value is hidden. I want to address the skepticism directly because I hear it constantly. The assumption that Social Security won't be there or won't matter. Here is what's actually true. According to the Social Security Administration, the average retired worker benefit in 2024 is approximately $1,907 per month. For a married couple where both spouses worked, combined benefits often approach or exceed $3,500 monthly. That's income you can't outlive. It adjusts for inflation each year through the COLA mechanism. The 2024 adjustment was 3.2%. No investment account comes with that guarantee built in. What most people miss is what guaranteed income does to the rest of their financial picture. If Social Security covers your fixed monthly expenses, housing, utilities, food, healthcare, then your investment portfolio is no longer in survival mode. It can stay invested. It can keep compounding. The withdrawal pressure that depletes so many portfolios simply doesn't apply in the same way. Think about your expected Social Security benefit. You can look it up right now on SSA.gov if you have not recently. Now compare it to your current monthly fixed expenses. Is that number close? Does it cover the baseline? Whatever your answer is, it tells you exactly how much work your investment portfolio will need to do, and how much it can simply be left to grow. There is one more piece of this that most pre-retirees do not see coming, and it has to do with a specific expense that tends to be the single largest source of financial anxiety between 62 and 65. I want to make sure you have the full picture on that before we go further. Reason 5. Healthcare costs stabilize with Medicare. Healthcare is the variable that frightens people most in the pre-retirement years, and not without reason. Private insurance for a couple in their early 60s through the ACA marketplace can run $1,500 to $2,000 or more per month, depending on location and income, according to KFF Health Insurance Marketplace data. Medicare eligibility begins at 65. The standard Part B premium in 2024 is $174.70 per month per person. Add a Medicare supplement plan and Part D drug coverage, and a typical couple's total monthly healthcare cost, while not trivial, is dramatically lower than what they were paying in the years before 65. That gap between retirement at 62 and Medicare at 65 is real, and it needs to be planned for. But once you cross that threshold, the unpredictability that makes healthcare so frightening largely resolves. You know what your premiums will be, you have coverage, and for most people, the monthly cost drops sharply. That is money that was going to insurance. Now it stays in the plan. It either reduces what you need to withdraw, or it stays invested. Over a retirement that could last 25 or 30 years, that difference accumulates. Reason 6. People downsize and unlock equity. Here's a question worth sitting with for a moment. If you own your home and it has appreciated significantly over the past 20 or 30 years, have you ever calculated what that equity would do to your retirement picture if it were liquid? Most people have not, and for many, the number is larger than anything else on their personal balance sheet. The IRS allows a primary residence exclusion of up to $250,000 in capital gains for single filers and $500,000 for married couples, meaning most people who sell a long-time home pay little or nothing in federal capital gains tax on the sale. That's a provision that can unlock substantial liquidity. A couple who bought a home in 1990 for $180,000 and sells it today for $520,000 in a typical Midwestern market can walk away with the difference, much of it tax-free, and apply it toward a smaller property. If the new home carries lower property taxes, lower utilities, lower maintenance costs, the monthly savings compound on top of the lump sum freed up. Not every retiree wants to leave the family home. That's a deeply personal decision and a legitimate one. But for those who are open to it, downsizing is one of the most underutilized financial tools available in retirement, and it often arrives at exactly the moment when the house has appreciated most and the space is no longer needed. Reason 7. Side hustles and part-time work. Retirement doesn't mean a complete stop. For many people, it means the first time they get to choose what they do with their hours. What I saw consistently, it was that people who had built genuine expertise over a 30 or 35-year career, that expertise still had value on their terms. Some consulted a few hours a week, some turned a long-time hobby into modest income, some taught, coached, or advised in ways that had nothing to do with their former job title. The financial effect is quiet, but real. Core expenses are already covered by Social Security and planned withdrawals, so any additional income doesn't go toward bills, it goes toward assets. It reduces what needs to come out of the portfolio. It keeps more invested. No commute, no performance review, no schedule that belongs to someone else. There's one final thing I want to cover before we get to the practical piece, and it reframes everything else in this video. Because what I've been describing isn't just a list of reasons, it's a system. And when you see it as a system, something shifts. Reason 8. Inheritance and windfalls. This one is harder to plan around because it's inherently variable, but data from EBRI and the Federal Reserve Survey of Consumer Finances consistently shows that Americans in their 60s and 70s are the most likely age group to receive inheritances. The transfer of wealth from the generation ahead is statistically concentrated in these decades. Beyond inheritance, retirement years often bring other unplanned inflows. The rental property finally sold, the old pension benefit that vested years ago and was never fully accounted for, the life insurance payout from a parent. These are things not to rely on, but they arrive with meaningful frequency, and when they do, they go straight into assets that were already compounding. The people who grow wealthier in retirement aren't just lucky, they're positioned to receive every one of these moments when it comes. Reality check. None of this is automatic. Everything I've described assumes a foundation, adequate savings built over time, debt that is not following you into retirement, a withdrawal strategy that doesn't drain the principal too fast. EBRI research consistently shows that Americans who enter retirement with significant debt or inadequate savings face a very different reality. But if you did the work, if you saved steadily, kept your obligations manageable, and are being thoughtful about how you draw down, then retirement isn't the financial cliffs most people picture. It is, for many, the period when everything they built finally starts working for them instead of the other way around. Conclusion. Here's the reframe I want to leave you with. What I described today, the tax restructuring, the expense reduction, the compound growth, the guaranteed income, these aren't separate benefits that happen to arrive at the same time. They're a system, and they all activate together at retirement for the same person in the same year. That's why the math can move in a direction that surprises people. It's not any one factor, it's the way they stack. The person who saved steadily, lived within their means, and planned carefully is not just secure in retirement. They're often quietly still building. Before you close this, I want to ask you to do one specific thing, and it will take less than 3 minutes. Go to ssa.gov and look up your estimated Social Security benefit at your planned retirement age. Then write down your current monthly fixed expenses. Subtract one from the other. That gap, that single number, is what your investment portfolio will need to cover every month for the rest of your life. Most people have never calculated it directly, and yet it's the most important number in any retirement plan. If something here shifted how you see your own situation, I would genuinely like to hear about it. Drop it in the comments. And if you know someone working through these same decisions, send this to them. Clarity like this is a lot easier to find when you're not figuring it out alone.